Hi, it's Robin Hart of the Home Loans with Hart team, where we work hard to help you and your clients build wealth through the financing of real estate. This is our weekly video where we share with you some market insights and analysis, along with other details that involve the housing and mortgage markets. Each week we do chart and try to kick off the video with our rates. So let's check out where those crazy rates are at. As of Tuesday, September 17th, the 30-year fixed 7-day average was sitting at 6.1%, while the 15-year fixed and 30-year fixed FHA were both sitting at 5.6%. That's all before the big news hit with the Fed. That's right. The Fed made breaking news yesterday with lowering of the Fed's fund rate by 0.5%, which is cool. Makes your phone ring a lot if you're a loan officer. But what happened to those rates? Well, they went up. You might be scratching your head, say, what? Okay, so let's dissect this down and break it apart for you. The Fed meets 8 times a year, and part of what they discuss is that Fed's fund rate that I'm mentioning. And that's basically what the Fed controls. It's a benchmark rate for the cost that banks charge each other when they lend each other money. Why is it important? Well, it speeds up or slows down the flow of money depending on whether rates are going up or down. Higher rates slow down money while lower rates speed it up. Now, we're not just talking any money like the money in your wallet. We're talking big money, billions and trillions. The Fed's fund rate also has a great deal more impact on short-term rates. These are things like credit cards, HELOCs, home equity loans that are adjustable, auto rates, things like that. However, those pesky mortgage rates, which are 30-year fixed, those are determined by the bond market. Now, the bond market is active every business day, just like the stock market is, and they have traders also like the stock market. And unlike the Fed, they actually meet every day, every business day, that is, whereas the Fed, again, they only meet 8 times a year. So when the Fed made their announcement, the bond market was hungrier for a bigger rate cut. After the announcement, the chairman of the Fed, Chairman Powell, expressed he was less favorable towards lower rates. The bond market and its traders didn't like hearing that. Those same traders had already priced in the well-anticipated rate cut that they were doing yesterday. So when Powell was a bit bearish on further cuts in his post-meeting interview, well, traders responded and rates basically went up. It's kind of crazy like that. So you see, the bond market only wants to trade, make money, sort of like the stock market. The Fed, however, is interested in the entire economy. They want to stabilize. They want to monitor. They want no recessions or mitigated market adjustments. They want low inflation with a target rate of 2%. They want low unemployment. That means below 4%. They basically want a well-balanced economy that grows not too fast and not too slow. Think Goldilocks, just right. All right. And the Fed isn't the only item making headlines. The U.S. homeowners have seen their equity gains continue to climb, even if at a slower pace in Q2. Maine, California, and New Jersey were the state leaders in equity gains, according to CoreLogic. And with all the news, there's been a surge in requests for refinancing. Those went up by 14%, given that rates have been on a downward trajectory for over a month now. And now this is great news. Let's talk about that home equity for current homeowners. It hit a record high of 32 trillion in Q1 of 2024. Just to be clear, home equity is not value. It's your value, then subtracting out what you owe on the home. So if your home's value is 400,000, but you only owe 250, your home equity is $150,000. Pretty easy to figure out what your home equity is. And with values continuing to be on the rise, equity gains are on the rise as well. And U.S. homeowners gained about $25,000 in equity on average since Q2 of 2023, which is fantastic news. And now I know many of you are saying, yeah, but there's tons of homes on the market and we're all expecting a housing crash. Well, again, it's not a crash. This simple chart can actually help. Yes, there are more homes on the market. That is correct. Take a peek. It's a very simple chart. In August of 2023, we had about 670,000 homes on the market nationwide. As of 2024, we have just over 900,000 homes on the market. Now, that's a huge increase. But check this out. We are nowhere near or close to the number of homes we had on the market in 2019. Now, that was 5 years ago. So it's not a housing crash. We still have fewer homes on the market than we did 5 years ago. We have more potential home buyers, a bigger population, more potential people ready to buy. So yeah, things have changed. And equity is not the only record setter going on right now. We are also hitting record high number of mortgage-free homes as well. Well, according to Mortgage Nuggets, 39.8%, almost 40% of all homes across the United States, they do not have a mortgage on them at all. Free and clear. That's beautiful. All right, let's dive into some of the more fun stuff. Michelin announced its 2024 list of the best hotels in the United States, and apparently 6 are actually in Dallas. And everyone thinks a spacewalk would be a cakewalk, except apparently for Jared Isaacman. Now, he's the billionaire that recently became the first billionaire to walk in space. I'm kind of wondering why Elon Musk didn't do it. I have my personal suspicions. He expressed that space is very hard and threatening environment. Kind of sounds like politics and Congress. And meme of the week is hello. Is it a mortgage you're looking for? Thank you, Lionel Richie. We appreciate that. At the end of every video, we do try to address when is the best time to buy. Best time to buy anything is when there is fear in the streets and your competitors are sitting on the sidelines waiting on rates to drop back to 3%. Hint, if they're not watching this video, they don't realize that they are not likely to drop anywhere close to that. If you like this video, please follow us on any of our social media outlets. We are on LinkedIn, Facebook, YouTube, and the artist formerly known as Twitter. Thanks again for watching and hanging out all the way to the end. I'm Robin Hart of the Home Loans with Hart team, where we are here to help you build wealth through the financing of real estate. We will catch up with you next week. Thanks so much and have a great week.